Bienvenidos y bienvenidas a Innovadores, el podcast oficial de EntreprenUp, el mejor lugar para descubrir historias inspiradoras, consejos y estrategias para ayudarte a alcanzar tus metas y hacer realidad tus sueños. Si nos estás escuchando en YouTube, apóyanos con un like, dándole clic a la campanita y suscribiéndote al canal. En Spotify, Apple Podcasts y Amazon Music, danos seguir y calificándonos. Hoy te hemos invitado a Carey Smith, founding Contrarian de Unorthodox Ventures, organización que colabora con fundadores disruptivos para generar una alternativa de financiamiento y asesoramiento a los emprendedores. Hablaremos con Carey sobre las ventajas de hacer las cosas sin dinero, las habilidades que solo los emprendedores sin financiamiento tienen y los riesgos de descuidar una empresa por levantar capital. No importa a qué te dediques, sigue innovando. Hey, aquí Sebastián Aguiluz, cofundador y CEO de EntreprenUp, y quería venir a contarles qué hacemos en la empresa cuando no estamos haciendo este podcast que nos encanta. Somos una empresa con cientos de speakers de todo el mundo que nos ayudan a crear espacios que democratizan el pensamiento emprendedor. Cada mes en la Ciudad de México tenemos eventos abiertos al público para que aprendas de los grandes innovadores y los diferentes lados de ser emprendedor. Y si quieres llevar a EntreprenUp a tu empresa u organización, producimos eventos, podcasts y talleres privados. Toda la información puedes encontrarla en EntrepreNup.mx o puedes mandarme un WhatsApp al +52 55 32 22 91 84 o un correo a sebastian@entreprenup.mx. Escríbenos y seguro podemos hacer grandes cosas. Hola, muy buenas tardes y bienvenidos a otro episodio de The Keep It Up Show. Aquí Sebastián Aguiluz, cofundador y CEO de EntreprenUp, y estoy con Carey Smith, founding Contrarian, que pues básicamente al rato les voy a leer un poquito de todo lo que ha hecho Carey para apoyar emprendimiento en Estados Unidos. Por el resto de la entrevista, esta entrevista va a ser en inglés, entonces pues perdonen mi inglés, pero le voy a dar la bienvenida a Carey. Hi, Carey. How are you?
Just fine. Thank you very much.
Really glad to have you here.
Thank you. I appreciate it.
Perfect. So, Carey, for the people who are unfamiliar with you and Unorthodox Ventures, can you tell us a little bit more about what you do?
Well, currently, Unorthodox Ventures, there's about 20 of us, and we invest in startups. Typically, I would say seed round and A round in the main. A large portion of the people that are here, there's about 20 people, came from the company that I founded back in '99, which was called a Big Ass Fan Company. So the people that I brought over from the fan company after I sold it to a PE firm were people that operated the company, the fan company. So several engineers, several marketing people, several people that were engaged in overseas sales, and supply chain people and production people. So sort of a mix of what you typically would find in a manufacturing firm. These were the best people that I had in the fan company after operating for 19 years. And so it's a savvy bunch. But when we look at investments, I think we look at them a little different than the typical VC, simply because we're not, we do have financial people, but we're not comprised of finance types. So it's not just money that we offer. And I know you hear that from almost every VC, but I think that the fact that all our backgrounds have anything to do, almost nothing to do with finance, tells you that that's where we are. And so we help people with, just thinking about several companies, we help people with the production, setting up production lines. We help them with the marketing, an awful lot. And we have companies that are outside the US, particularly in Europe. We're bringing them or helping them enter the US market, which is a large, very diverse market, is something that that they're in need of. And so setting up operations here and using the money to do that comprises a lot of what we do.
Perfect. Before we go to the next question, I don't usually do this, but when I check your LinkedIn, I love your description so much that I just want to read it really quick. It says, every year entrepreneurs start more than 500,000 companies in America. Only 200 of them will ever reach 100 million in revenue. Carey Smith, knows what it takes. He led a company from 0 to nearly 300 million in 18 years. What's even more unusual is that he did it without no towing to investors or anyone else. Carey says his secret to success is just common sense, and he's happy to share it with anyone willing to consider an entirely different kind of business plan. And I didn't want to just read it because I really liked it. I also wanted to read it because it follows to my next question. So incubators, accelerators, VCs, they all have their formulas, their way of doing things, and the way of telling a founder how they should operate. And I understand they are formulas that have worked in most cases. So in your case, why did you decide to use a different kind of way to make a business plan and start a startup?
All right, and are you referring to the way I did it at the fan company, or are you referring to the way that I suggest people do it?
Both.
Oh, okay. With the fan company, I had no idea of. I mean, the only thing I knew was what I had done in the past, and so I didn't go to business school, and I avoid reading and always have avoided reading business books, and so it was sort of homegrown. But I mean, it was very simple. As you said, I didn't raise outside money, so obviously I had to conserve money, and everything was built around cash, to be honest with you. And so everything we did at the fan company, we built ourselves, our sales organization. We hired salespeople. We didn't use reps or agents. We did the marketing ourselves. So we wrote all of the ads, we wrote all of the stories, we did all of the PR, we did everything ourselves. But that was driven, honestly, by the fact that, at least in the beginning, we didn't have any money. We had to do it ourselves. When we talk to companies today, or we talk to startups, I do tell them that they should be very, very cautious. It's very, very easy for somebody that is starting a business to give away more equity than's necessary. And that's why I think it's important, before you decide how much money you need and what your valuation is going to be, at least your first raise, that you know how you're going to spend it. And the only way that I know to do that, or to advise somebody to do that, is to build a plan from the ground up. And it has to be, it almost has to be with an eye towards cash on spending. It also, when you do that, it lays out in your mind exactly what you're going to be doing. I mean, as a entrepreneur lays out a timeline and lays out how you should be organizing things. We use Gantt charts so that we can see this, because there's an awful lot that takes a lot more time to do than most people imagine. And I'm a very strong believer in doing your own marketing and your PR, because you're never, it's very difficult, almost impossible to find a good marketing agency. I don't, honestly, I've never come across one, though I've been involved in doing this sort of thing for a number of years. And I think at the end of the day, the best marketing comes from the entrepreneur, and conceivably hiring a journalist, unemployed journalist, hopefully, to work with them on the story, and to build what in their minds, in the entrepreneur's mind, is a very, very important set of information. To a PR agency or an advertising firm, you're just one of many, and that's why they don't work very well. It's easy to hire them. It's very difficult to get anything of value out of them. Same thing applies on the sales side, the sales channel. It's very easy to hire independent representatives, but it's, in the main, it's very ineffectual, especially when you're just in your startup phase. So I think that building a plan from the ground up is the only way. I have no idea, quite honestly, how most VCs do it. I can imagine, because they're steeped in finance, that they look at things from top down, and having never built a business themselves, other than their investment firm, wouldn't know how to do it anyway. So
obviously, money helps any founder to accelerate their growth, but what are the skills that you think entrepreneurs who don't get investment, or who just start bootstrapping from the beginning, have, that other entrepreneurs who raise money don't have?
well, I think the difference is, I bootstrapped, and you're right, money helps. But to tell you the truth, if somebody had given me $5 million the day I started the business, I would have less equity, and I would have spent that money on, I don't even know what I would have spent it on, because I certainly didn't know where to spend it. But the fact that it was, in essence, very easy for me to get, I would be inclined to think that it would be misspent. What we see is an awful lot of founders that attain money, or obtain money from others, is that it's helpful only if they know how they're going to spend it, where they're going to spend it, how much they're going to spend. If you don't know, it's not worth anything. You're just messing around. When you're bootstrapping, you have to be very careful, which means that you have to know everything there is to know about your product, about the market, about the channel, the sales channel. If it's a manufacturing product, you obviously have to know not only how it's designed, you have to know on the quality control side that it's being done properly. It's a bigger problem. It takes more effort. I think that the fact that most startups that are financed by outside money fail tells you something. Money is very useful. I think in retrospect, I could have used it, but I would have had to. You have to know what you're going to do with it. It's not a magic elixir that solves all problems. It many times can obscure what the problems are. And we've been involved with some companies that have the money and had easy access to the money, but even after several years, when they start to have problems, and now they need more money because they're not generating enough income to cover cost, they have big problems. And the problems they have are, one, at best, if it's an up round, they lose equity. And, you know, at the end of the day, I mean, I sold the company for 500 million. They wrote the check to me. That was my money. I did give 50 million of it away to people that I worked with that helped me, but it was mine. It wasn't some silent partner that had just invested money in the company. So I think at the end of the day, you have to think about it in those terms, because you're selling, when you give equity away, I mean, it's your baby and you're giving it away. And it's very easy to give something away that you don't completely understand, you don't realize the value of, but I think you have to be very careful. And when something is easy and when everybody's doing it, normally that's not the way you want to approach things. That tells you, it's a marker. It tells you that maybe you should look at this in a little bit more detail. As I say, I agree with you that money helps, but it helps only if you know how you're going to use it. And having a large valuation is not necessarily, I mean, it's great to go home and tell mom that you've got, $10 million for this crazy idea you had, but it doesn't bode well. You have to pay attention. It makes you work more than you might want to. And unless you're able to actually grow revenue, you're going to be right back at the trough again with a less interesting story, and you're going to need more money and you're going to lose more equity. And this is why we talk to people. It's very interesting. We see people all the time, and it's very sad, that come to us and they're the original entrepreneur. They're the original, they're the founder, and they've been at it for, a couple, 3, 4, 5 years, and they're looking for millions, and they own less than 10% of the equity. And from my perspective, that's losing. That's not running. You're working for somebody at that point. If somebody owns 90% of you, that's work. And you might as well that's just ridiculous. But people get themselves into this situation all the time.
Following up on what you're saying, do you think there's been good entrepreneurs that didn't become great entrepreneurs because money came too soon, as you mentioned? Maybe money kind of ruined them because they had all the resources before they even figure out what they were really doing.
No, you're right. I mean, I think we all have either known people when they were kids that had a lot of money. Their parents gave them anything, everything, and oftentimes they don't turn out so well. I think in business, it's the same sort of thing. You've got to be very careful, and that's why I say the first thing that we recommend that people do before before they actually even start looking for money is build a plan. I mean, know what you're going to do, know how long it's going to take, because that's another thing that is a problem. Is sometimes when you start a business, you really, your timelines, I mean, you imagine, oh, it's going to be great, it's a great product, I know what the heck I'm doing. This $1 million or $3 million or $5 million, it's going to take me through. I don't see raising for years. If you've never done it before, it's amazing how much money you can spend on just little, what you imagine as small things, because what's hard to project are all of the mistakes you're going to make. And no matter what, you're going to make mistakes. And no matter what, I've been doing this for a long time and I still make the same damn mistakes. I mean, at the fan company, we had a very, very large, we had 1,000 people and we had a very large engineering department. And when we wanted to get something done, we got it done. The way it is now, if you're starting from scratch, you don't have that, and you outsource it, and it's not as if these people know what the heck they're doing all the time. I mean, you could get lucky and get a good engineering group to work with you, but by the same token, even the best engineering group, if you're actually building a product, it takes a lot of, normally it's a number of iterations, a number of tries, and a lot of testing, and a lot of retooling to get it the way it should be. So it takes longer and it takes more money, but you have to make sure you're spending it, if you've got the money, spending it in the right way, and that you've got enough in reserve to fix the mistakes that you're undoubtedly going to make.
Carey, in India, there's a word. I really like the concept of it. It's called Yugad, which basically means, by translating it, the innovation that comes from adversity. And I think it's a little bit what we're saying. Like, when you get all handled, it's a happy problem, like, right? Like, I have more money, or I have in paper, the toughest thing to do, which is get the money to start the company. And because of what we do in EntreprenUp, I know hundreds of entrepreneurs from Mexico and from other countries, and there's something really rich about seeing someone who didn't get the funding at the beginning, maybe they didn't even get the funding at all, and still made a great company out of nowhere, and decided to just prove the concept with whatever they had at the time. And I don't know, maybe it's a happy problem that you have the money that you require, and that what some paper is the most difficult thing to do. But yeah, I think there's a real opportunity of growth for entrepreneurs. The entrepreneur life isn't an easy one, and it's more difficult when you don't have the money to start your idea or to make it as big as you want from the beginning. But I think there are, as the word says, opportunities in adversity.
No, I agree with you 100%. I mean, it's difficult to imagine that that despite the fact that you want to be an incredible golfer, that when you start, when you're 6 years old or 7 years old, that I mean, you have to work yourself up. I mean, the great golfers and I mean, any sort of sport, anything that you'll ever do, even study, even academics, you have to work at it. And the people that do work at it, the entrepreneurs that have to do it themselves, there's something there, it shows a grit, and it indicates, to be honest with you, it indicates the sort of company that you'd want to invest in. I think a lot of people start companies and imagine that what a VC or what an investor wants to see is their ability to raise money, which has nothing to do, I mean, from my perspective, is just, it has nothing to do with running a business. What people really want to see, what we like to see, are people that actually have come up with a product, have built a product, have taken it to market, and actually understand the market, and probably have pivoted several times. And again, they're very economical, but to do that sort of thing without a lot of money proves that those people have character, and they have drive, and they're the sort of people that you want to invest in, because they're the people that ultimately are going to succeed. We run into a lot of companies that they're really good at raising money. I think they actually think that that's business, and maybe it is. I'm not saying it's not business the way I look at business, but if all you're going to do, I mean, you know, if you come out with a round K or a round L, I mean, well, okay, so you raise money, but you're not building a business. And I think that at the end of the day, people that are able and willing to go through it, if they're able to get it to a certain point, and I don't even know what the sales are. The sales could be, it could be very low sales, but the fact that they stay with it and put forth the effort, I think that bodes well for them if they want to raise money. But again, people like that are going to be much more careful with how much equity they part with, because it's sweat. They don't want to part with it, and so they're going to be a little bit more careful with the money. And I think that the one thing that I've learned in the last 4 years in doing what we're doing here at Unorthodox Ventures, investing in other people or investing in other companies, is that the most important thing is the management is the person that is driving it. It's not the product. And honestly, when we started, I figured, oh, I know enough about this. I'm looking for really good product, and that's what makes it. But in fact, that's not what makes it. There's a lot of people that have good products, that have good ideas, but simply cannot manage and can't manage a business, and they can't really get it to a point where the business has developed revenue and can break even, and then can get to the point where the real money is not in raising money. The real money, big money, is in operating the company and ultimately conceivably selling the company. That's the big money. The other stuff is, it's just a VC paying you for your time, and you have to be careful with that.
Do you think this tendency to, because there are a lot of entrepreneurs who, as you say, basically what they do, they basically don't operate their company anymore, but they are just raising money and raising money and raising money. And maybe the LinkedIn says that they are entrepreneurs, but they are mostly raisers of money because they forget about
that. Yeah, they call them debtors. They used to call them debtors. It wasn't something that you would be necessarily proud of. Basically, long-term failure, right? Not what you are proud of.
Yeah. Do you think it's because maybe it has come to a point where sometimes it's easier to raise money than to operate a successful startup?
Yeah.
Because there are a lot of startups that raise money, and
you're exactly right. No, you're exactly right. I agree with you 100%. We see it all the time. And actually, we're very, very cautious, because a lot of people that come to you, that one of the first questions is, do they have a plan to go into business? Or are they just raising money? And some people are very adept at raising money. And if, again, I'm a little cynical, but if that's, that I don't consider that a business, though I guess you might look at that as a business, but it's certainly not a business. You can't take that to the market. Ultimately, that fails, because ultimately investors look at it and say, well, what's going on? If this is going to continue, it's going to have to be a down round, and you're going to lose, even more equity, and you're not going to get what you want. So yeah, no, we see that all the time. I think honestly, there's a lot of people that do that, but the reason for that, I believe, is in various magazines and in newsletter, all sorts of things, that people that journalists who really do not understand business very well, at least most of them. There's some that do, but it's amazing to them, these kids, as a 25-year-old or a 30-year-old person, that you can raise these incredible amounts of money. It's interesting for sure, but I think it's based on, one, a lot of journalists writing articles that basically say, "Oh, this is wonderful. They're incredibly successful," and the fact that at least until this point, for the last couple of years, that interest rates have been low, investments in public markets have not produced or have not there's potentially more returns, higher returns by investing in small private companies. And I think that's what's driven it. And it's we'll have to see what happens going into the future, because it'll continue until it can't continue. And when money gets tighter, conceivably, then you're not going to be able to raise the next round. And if you don't have revenue, you're going to collapse. And I mean, that is the most likely mode of failure for a lot of these people. It just is.
And maybe that's the reason why unicorn companies after their IPO just don't work the same way, or
Yeah.
the reason why WeWork Slash, etc. When they went public, then the investors, well, the finance analysts look at the company and they're like, this doesn't work. There's no way this is profitable in the long term or in the short term. So, but yeah, as you mentioned, since they are raising money and then everyone is happy. I call it a happy game, because the investors are happy from the second round because the investors from the first round are happy because there's a second round and they are richer when they cash out. The entrepreneur is happy because he has more money. The second round investors are happy because they just made an investment that they think works. And then there's the third one, and it follows and it follows and it follows. But there's a lot of people who work at those companies and that depend on a company that keeps working at the long term. In several cases, they even have shares of the company and they buy in the vision of the founder or founders. And I think as an entrepreneur, you owe it to them to try to make a sustainable company and to make a company that it isn't just good in in raising money, but also in creating jobs and being sustainable and making the impact, whatever impact you are telling everyone you are making. Because it's really easy to sell, sorry for the word, but it's really easy to sell the bullshit that you are changing the world and raising money and impacting I don't know how many people. And then, well, the money drain eventually happens and there's
no, you're exactly right. I mean, you're exactly right, because what the ability to raise money is sort of shrouds your ability to run a business. And because if the company is always able to raise money and build the valuation, it has to continue. If it doesn't continue, the whole thing falls apart. And then when it hits for example, when like WeWorks, when they hit the public market, the public market looks at it and goes, well, this is junk. They can't make money. They're not going to raise any more money. They're going to have to support themselves through revenues and profits. And then that's the public market determines they can't do it, and the price of the shares fall. And that's all that is. It's just the way it works. I mean, that's if you go public. If you don't go public, and there's reasons to go public, there's lots of reasons not to go public. Then if the investors don't continue to invest, if it's not easy to raise money, then you're going to collapse. I mean, that's the way it works. I mean, it's not rocket science. And I think that being sort of not so contrarian, but maybe sort of conservative business in as relates to business, is that at the end of the day, I think that the successful entrepreneur is wants to make sure that they're making money, that they can actually pay all the employees. Because you're right. I mean, you can. I mean, it depends on how you look at life, but the way I look at it is you have a responsibility to your employees, people that are working with you, to support them. And if you can't do that, if you haven't built that, then I don't know what you've done that's memorable. You've done nothing. You've taken money yourself, and you obviously, or you in all probability have lived better than you would if you hadn't raised money, but your employees didn't take advantage of that. And you could have had stock options, but it doesn't mean anything when the company collapses. They're worth nothing. So yeah, no, the simplest approach is to start a business where your thoughts are deriving money or profits from revenue that allow you to pay your employees, that allow you to pay your suppliers, that allow you to make a substantial investment in the community. In my way of looking at it, it's not ethical really to just raise money to raise money, and yet that you see an awful lot of that. And I don't know if I have no idea how some of these people are thinking. There may be, oh my gosh, if I could just raise a little more, I can get the business to the point where, I can support everybody and everything. That may be the case. Maybe it's the case. Maybe it's, I don't know. I don't know how often that's the case, but it sure as heck seems like there are a lot of people that are just raising money to raise money, and that's the business, because the individual that's doing the raising, the entrepreneur can have a good life. And I know people that do it. It's ridiculous, but it's not, I don't know, that's the way I look at things. That to me is not fair. It's not even honest. But and the VCs give them money because there are other people outside of that community that have invested money in the VCs in the hope that they're going to make money from that investment themselves, the partners, the limited partners, and the VCs, having sold themselves as being a good way to make money for the LPs, they have to invest it. And it's a crazy circle. It's not a virtuous circle, I think, many times, but it's interesting. And what's going to be interesting, I think, is the question is how long. I mean, when does the music stop? Because at some point the music stops. This doesn't go on forever. If the interest rates go up, who knows? It's very interesting. It's an interesting thing to look at and to imagine. And I think from your position and I just talking to you, I get a feel for the way you look at it. I don't know. I mean, is it justice at the end of that? I have no idea. But people are going to get hurt, and innocent people are going to get hurt. But I think from an entrepreneurial perspective, you have to do, if you're driven to, I think entrepreneurs are driven. It's not a money thing. If you're I won't say a true entrepreneur, but it's beyond money, because they do what they do. They have to do it. They have to do it. Even if everything was taxed away from them, they would still have to do this. It's a disease. It's a curse in a sense, but there are people that you can't think of doing anything else. This is the most challenging, most interesting game, and that's the game they play. But they play it regardless. And so when all the investment slides away, all the VCs decide that they're not going to invest any more money, there's still going to be people out there, a lot of people, that are still going to do this because they're driven to create, and this is the way they create. So.
Perfect. Talking about when the music stops and starting to wrap this up, Carey, the last question we make every single guest is 3 do's and 3 don'ts for entrepreneurs. Basically, 3 things they should do and 3 things they shouldn't do. So what are your 3 do's and 3 don'ts for entrepreneurs?
If they haven't been obvious so far, I mean, I think the first thing is you've got to have a plan, and you really do have to have a plan. And it's almost a day by day, a week by week, month by month plan. What's going to happen? Where is it going to happen? How much is it going to cost? How many people do I need? When should I have hired those people? How are they going to be paid? I mean, all of that. It's just simple business plans. The second is I would keep in mind, just as we've been talking about, when you're in that phase, because everybody's in a phase, even if they raised money, they're in a bootstrap phase in the very beginning, is that you need to consider, everybody imagines they're going to be successful. A lot of people aren't successful, but some people are successful. And you have to have your mind on, if I am successful, how am I going to get paid for this? How is this going to work? I mean, am I doing this? Who am I doing this for? And you could build a business and not really think about profits, not think about selling the business, just think about, I'm building a nonprofit. Why am I doing it? Who am I going to help? How is this going to play in the long term? Then I think that my general business approach is to be very, very transparent. And so I think that people ought to be very transparent, and by that I mean honest, with the people that work with them, that the people that they're providing product for, and their suppliers. And I think that honesty is always the best policy, and I think that in the long run it pays. And typically what that means is that you're planning for a longer run, so that you're not worried about, and it's terrible to be in a situation if you're worried about week to week, month to month, and we've all kind of done that before, and that's not a nice place to be. But ultimately, you have to recognize that in order to build a business of any size, you have to be accepted by a lot of people, and people accept you when you're honest. If your product doesn't work properly and you're not spending money on maintaining it, people are going to see that, and your business is not going to go anyplace. If you don't pay your people sufficient wages, they're going to leave you. If you don't pay your suppliers on time, they're not going to supply to you. So those are things that I would definitely do. Things I wouldn't do, of course, outside the things that I just said that you should do. you should do those things. Don't not do them. But I think the main things there are to be honest and to not exaggerate. Even if you're looking for money, it's a terrible, you don't want to put yourself in a situation where you say, I need $10 million, and you have no idea what you're going to do with it, because you've just taken $10 million from a group of people, and you owe them. I mean, no matter how you look at it, you owe them your best efforts. And so you don't want to make people think that, oh my God, this is $1 billion market, when in fact you know full well that you're going to be lucky if you get it beyond 50 million. So you have to be honest. Don't be dishonest is the negative part of that. I don't know. I don't think about things, and maybe this is an entrepreneurial thing. I don't know. I don't think about things in the negative. And so it's hard for me to say, don't do these things. I mean, you shouldn't raise more money than you need. You shouldn't underpay your people or anybody else. You should always be very honest in your approach to business and anybody associated with that. I have a hard time with that. I really do, with the don't do these things. Be honest. I mean, that's the big thing. Be honest, do your best, and make sure your product is the best, regardless. And that's true whether it's software or, you know, a blender. Who cares? I mean, that's a main thing. I'm sorry, Sebastian.
Well,
That's the best I can do on don't do this.
no, those were great. Those were great. Hey, Carey, if someone wanted to learn more about what you guys are doing on Unorthodox Ventures, maybe, I don't know, apply to find a new way to be an entrepreneur or whatever, how can they find you, and how can they find more information in social media?
Sure. I mean, if I were they, I would go to LinkedIn. That's an easy way to do it. That's probably the easiest way to do it. They can go to the website, which is unorthodoxventures.com, and just write us a note. But yeah, no, I appreciate, I talk to an awful lot of people, and an awful lot of people we don't invest with and are in, and people that know we're not going to invest in them that sometimes don't even have a business or don't have a business at this time. So I don't mind talking to anybody. Anything. I think being an entrepreneur is very interesting. I'm so happy that I found myself in this situation. And I think that anything I can do to help other people that are thinking like this, I'm happy to do it. Perfect. So definitely. Perfect. Love to be in touch.
Perfect, Carey. Well, I want to thank you for your time, and hope you had such a great time as we did. And as we say on this program, keep it up.
Okay, I try. Okay. Thank you, Sebastian. It was very nice.
Si te gustó el episodio de hoy, recuerda que puedes encontrar todos nuestros episodios en YouTube, Spotify, Amazon Music y Apple Podcast. No te olvides suscribirte a los canales, calificarlos y comentar lo que te parecieron. Y por favor ayúdanos compartiendo el episodio para que más personas se enteren de este podcast. No importa a qué te dediques, sigue innovando.